Hi, I'm Steve Podmore. Well, I'm the founder of Transform Global. Many of you know that already. And this presentation is going to talk about the vision for the SDG 360 Gamechanger Fund, which is part of the model for our new World Bank, but better. So we'll get right into it. Now, we've already talked about the bank itself. We've talked about the media properties, the investment opportunity, the funding strategy, and it's important to recognize when you're watching this video and hearing about a 9 billion fund that could be listed in 3 to 5 years, 3 to 4 years, and raise another 5 billion at IPO. It's very, very important to understand it in the context of that investment, that funding strategy, and how the model, we believe we can get some very, very important institutional investors, some of the largest investors in the world, into this fund. And there's a way that we believe we can do it. Of course, we can't do it from a standing start. We've got to put in place the talent, the capability, the infrastructure, and of course, the communications. But especially, we have to put in place the partnerships that are fully incentivized. So that's covered in the separate video. But it'll also be covered a little bit in this one right now. So we're going to talk about the features of this incredible fund that could change the rules of the game to do capacity building at scale and really create a very powerful model that can be across the broad impact and infrastructure and technology and impact space broadly across all of the Sustainable Development Goals. Of course, the name SDG 360, so it's designed to be holistic. 360 is an important number that you'll learn about when you watch the video because we realized in the development of this a couple of years ago, or I realized that there is a real importance to that number. You'll find out about it in a moment. But it's about supporting big impact game changers, the Gamechanger Fund. That's entities that could be anywhere in the world that are tackling the SDGs directly and indirectly, and in a way that's incredibly complementary and really it's a whole systems approach. So let's get into it. So we talk about connected capacity building. What does that mean? Well, it's really about we are doing the early stage capacity building and connecting it with follow-on capital, but also the ecosystem to fully validate, to fully support and due diligence those projects, but to do it fairly and objectively and with an approach to capacity building that's like no other. Well, 360 degrees, a whole system design, we've talked about that. Second and third order effects. So it's not just about the financial return. It's about the role in the ecosystem, and it's also about the impacts generated, social and environmental. But of course, there's got to be great governance in there as well. And to build that, to come in as late stage investors like many do, they're often playing a catch-up game, frankly, and that's why the failure rate is often quite significant. This approach, on the other hand, isn't standalone from the basis of a fund. It's a fund that is run and raised in conjunction with a very significant bank, but also one that's got media properties that are very much about supporting the whole impact agenda. So those second and third order effects are really important. I've just gone a little bit too fast there. But of course, the SDG themes and sub-themes and stages are also what this fund is designed to address. So we've talked about this previously. Permanent capital is designed to list on like a 10-year fund. We believe the value of providing a permanent capital structure. Initially, of course, it's a private structure, like any equity investment. It's not on the public markets initially, but the design and structure of this is to put it on the public markets within 2 to 4 years, possibly as late as 6 years. But really, the 2 to 4 year sweet spot is what we intend and what we think is appropriate. But market conditions have got to work at the same time. that 2 to 4 year listing period. Now, a key component of the fundraise, as I mentioned earlier, is in the funding strategy document. You can or video, and indeed the entire summary, you can realize how we will be raising 3 million, then 50 million, and then a 300 million pound combined raise. And what's attractive about that combined raise, and we believe we know the high value added investors, of course, we've got to get them on board. We've got to be credible first. But by having those high value added investors, they'll be putting 100 million into the bank as equity. And for that, they also get some bonus options on the fund. But in addition, 200 million is discounted equity in the fund. Now, it's only paid over, though, when the fund is raised. And from that 100 million, just to round this off, so anyone who's not seen the other video has an understanding, that will help us put in place the talent and expand the elements of the bank, including the media properties. But it also enables us to take 10 million and pay retainers for mainstream investment banks to help raise that 9 billion net fund. Now, as we see, 9 billion net full fundraise and 10 billion at launch capitalization. So basically what that applies is 9 billion, 90% of the equity will be in the fund to those investors in the 9 billion of equity. And this is unleveraged. We'll talk about this in a moment. So it's 9 billion of equity with the expectation of listing 2 to 4 years later. That additional 1 billion is made up of the discounted equity for those who are investing the 200 million, the conditional 200 million investment. Also, the existing teams and others that we will be, other investors that we'll be bringing on board, they will have around about 300 million of cap. And the other 400 million would essentially be what we call the restricted impact options. So they are essentially replacements for carried return. Now, that 400 million of fund units, of course, it can't be realized until there is considerable value. So it would be worth a lot more, but also the fund would be worth a lot more as well. But that's essentially in pre-dilution what the cap is, or the capitalization of the fund is designed to be at launch. Now, that 200 million that we spoke of, that becomes the success fee. So it's paid over on the launch of the fund. There is 9 billion net in the fund, and that 200 million goes to cover that ecosystem of mainstream banks and placement agents who help us close that 9 billion fund. So it's about 2.3%, I believe it is, or thereabouts, and a reasonable, or 2.2%, a reasonable figure. It isn't an excessive figure, but it would be paid over a period of time, not as one lump sum. It would be paid over 12 to 18 months, and it would be conditional on those parties being part of the ongoing ecosystem. And they could even forfeit some of those fees to be longer holders in the bank with equity as well. Now, as we said, the fund will do off and on market investing, meaning the off-market investing will be those private transactions through the butterfly basket portfolio structure. It will have a holding in the bank itself, and it will also do direct transactions into what we call special opportunities. But where we're talking about on-market, we will be investing through trusted third parties that come in part through that ecosystem, who are also wanting the deal flow the bank can actually deliver them. So there's many benefits on both sides, but we'll be allocating capital into liquid or semi-liquid strategies that those top fund managers can deliver. We'll talk about that in a little while, but it means what the ultimate investors in the fund get is they get dynamic diversity, they get risk management, and the ability to have multiple ways of tackling the strategic impact issues that they care about very much indeed. So as we said, the zero carried return, which is attractive in and of itself, And all of the incentives are based on not just financial performance, but the impact performance, those restricted impact options we've devised. So there will be a 2% management fee, and we referred to this in a separate video talking about the bank and the asset management group, the SDG 360 Fund Management, who will be the team managing this fund. And that 2% of fees will be reevaluated every 5 years, although initially it's 180 million a year. And then when the IPO occurs, assuming we raise a further 5 billion based upon the net asset value at the time, assuming just the 9 plus the 5 means the fund structure will be around 14 billion pounds. So 2% of that 14 billion would be 280 million pounds per year of fees, half of which would be going to the bank and half would be going to the fund in order to manage, the fund managers in order to manage the fund. So that's the design. And we believe that is more than fair, and it enables us to generate a really amazing return as well as incredible impacts. So when we talk about strategic equity, many sovereign wealth funds, many institutional investors, they're desperate for the kind of deal flow that this is quality deal flow that the bank in all of its forms and the fund can deliver. So in order to hit their sustainable investment targets, in order to tackle the issues that they say they care about, they need that deal flow, that due diligence deal flow that this bank and fund structure are able to deliver. Now, of course, we want to work with the best of them, and we want to work with them in ways that really closely aligns with their strategic needs to generate jobs, very large quantities of good jobs, but also to address all of the sustainable development goals. So by operating at this scale with governments, with sovereign wealth funds, with institutional investors of all kinds, we think that 9 billion, particularly in the way that we intend to do it, can be raised in record time. But of course, these are bold numbers, and we recognize there's risk, and this may never come to fruition. If it never comes to fruition, the activity that we launch with the first 3 million and 50 million and potentially further rounds thereafter still mean we can achieve incredible things. But ultimately, to tackle the sustainable development goals at scale and speed, we believe highly catalytic initiatives such as the SDG 360 Gamechanger Fund and Transform Global are truly important. Okay, so we're talking about blend potential, and a big part of what I talk about is often the need for blended capital and blended capital solutions. Now, of course, the investors in that 9 billion fund, they are a blend of sorts. But what they aren't, they won't be investing with different classes at that point. It is designed to be 9 billion of ordinary equity into the fund with D shares, which is D shares that will give governance rights, but actually no direct voting rights, no veto over investment decisions. That comes through the governance foundation, and that is designed to be more than adequate and very, very beneficial to those institutional investors, because also we want to make sure that they are not accused of addressing a particular agenda or using a dominant position, for example, to push that agenda. So the governance structure is designed to work for them, but to insulate them from those external risk factors or perceptions. Now, but when we're talking about blend, what we have is a structure that is totally unleveraged as it stands. Now, what we believe we have the ability to do is to raise on top of that 9 or 14 billion additional debt, strategically underwritten debt. So where philanthropists or governments, or indeed some of the other investors, are able to underwrite a portion of debt that enables us to leverage the portfolio collectively or indeed on strategic investments individually. Now, we leave all of that out of the model because it's far better to be conservative. Now, when we're talking about a 9 billion fund, you could argue this is not conservative. But what we really are, if you look deeply, is conservative in this approach. And it works without any leverage. Now, what's key is we would not over leverage. We wouldn't put the fund at risk. We wouldn't take undue risk, and the governance structure prevents us from doing so. But it allows intelligent leverage, meaning as long as the portfolio is in a certain position and there's certain diversity, then debt appropriately applied, particularly when it's guaranteed through third parties, means the debt can be at low cost and it can dramatically improve the ability to generate the impacts that we and the world seek. But of course, that enables us to generate an even healthier return, which then enables us to accelerate the impacts. So we talk about catalytic impact. Of course, that's the focus, directly and indirectly. Compliance is a very big part of the model, directly through the compliance functions of the bank that you might have seen earlier in the other video, or indeed through the governance structure, through the Transform Global Trust Foundation. But of course, there's a big part of risk management through the application of technology and through the application of the portfolio structures. So what we call the Augmented Intelligence Decision Support Engine is a technology that will be part of our overall CRM, our customer relationship management systems, and our management information systems that enable us to really understand when organizations that we're investing in need remediation, the ones that have the greatest potential. It really enables us to tap in the wisdom of intelligent groups, not just the people who are doing the actual investment management or banking support to those teams, but the broader ecosystem, which is the investors, the NGOs, the actual deals themselves, the investments that we're making. All of they have the ability to contribute and get something back for being part of that augmented intelligence decision support engine. And it's really, really powerful when looked at in the broader context of the fund. So we mentioned there's 4 things that the fund will do. One is what we call integrated investment, these are integrated investment strategies. So one is our strategic investment. So the fund will be hardwired. Part of the condition of raising it is it will make a £400 million B round investment on agreed terms that are already laid down and you can read about in the investment opportunity video. That £400 million investment means that the bank is properly capitalized, and because money from that will go into the media properties and into other investments, that means we're best able to support the fund. But it also means that the fund investors, because they have a stake then in the bank, they succeed if Transform Global is a success, but also Transform Global benefits and all its personnel if the fund is a success. It's fully aligned. So hopefully that makes sense. And obviously, if Transform Global is properly capitalized, then that works for absolutely everybody. So that's part 1. Part 2 is the special opportunities allocation. So what we'll be doing there is using our balance sheet effectively of the fund to seed and lead complementary funds and platforms and structures. So what that means is we'll be investing at an investment management or an umbrella level. For this allocation, it won't be into the underlying fund. It will be into the management teams and the management operations, a little bit like investing into Transform Global itself, but to many other fund structures, platforms, and initiatives that are relevant and complementary, and that could be expanded. Now, the bank could, of course, help them raise that capital and be paid a fee for doing so. But also by seeding and leading them, We also have the ability to push and to help make sure the right governance is in place and really make this part of the family. Those will be transaction sizes of anywhere from 10 to 40 million. Of course, we want to make a return on those investments, but we have a flexible approach to how those returns can be generated. And we know that just a handful can more than compensate for the ones that generate lesser or longer returns. Now, what's interesting about this model is it means that we also have the ability to seed our own other fund structures like the SDG 360 Gamechanger fund, where we might do a US version or a African version, for example, or smaller versions. So it means that we can replicate our own model in other geographies or more completely over geographies that we might only just touch in the existing SDG 360 Gamechanger fund structure. So 2 out of 3. So the third part is what we call active impact direct investing. And this will be through the butterfly basket portfolio structure. And we think this is a massive breakthrough in investment design. So you can see the two intersecting triangles there. And those two triangles, they represent a system which is shown very briefly. You can see all the colors of the SDGs, although, of course, we won't be structuring it quite this way. We just wanted to show the colors and the fact that it's the themes and sub-themes. So the left-hand wide triangle, which narrows, what it represents is the many deals, so many small deals that essentially get progressively smaller in number, but larger in capital. So the blue shows how the capital allocation increases as the number of deals decrease. So many small progress through stages to get to a few large. So that's really showing it at a very high level. It's a portfolio, it's a basket, and it looks like a butterfly. However, let's look at where the deal flow comes from. So the deal flow comes from a variety of sources: big crowd and funding the globalgoals.tv. It can come from our existing and our additional marketing and outreach specifically for target deals. And we can use the due diligence mechanism from the crowd and from our augmented intelligence decision support engine to help narrow from what will be probably many opportunities to a smaller number of doable deals. I mean, even though we're talking volume, we're not talking tens of thousands. We're talking a few hundred a year, which you'll hear about in a moment. Of course, we can work with other impact investment funds that don't either have the capacity directly or might have invested at an earlier stage. University and corporate venturing. We've also got the ability to work with partners and professional services firms, and there's many that will be included in that ecosystem. Of course, the acquisitions and investments that we make through Transform Global Investments, and foundations and NGOs. So the deal flow can come from many places. But let's look what it looks like in detail. So each investment cycle, we plan on doing 360 investments. I mentioned earlier the number 360 comes in to this system a number of times. And each of those investments would be $500,000 of cash and $500,000 that pays for thorough and organized help and support. And what we're doing is we're making sure that the equity that we receive for those investments, it would be based on the full million, but it doesn't have to be at a tiny value. The values can be based upon the size and scale of the opportunity. But of course, we're not going to overpay and we're not going to underpay. It really is about partnering with people who recognize the big value that we can offer and recognizing we need to get close enough to really understand how we can help and are they worthy of follow-on investing from us. Now, we might not choose to follow-on invest. We might just choose to help them raise other capital from investors that are more appropriate. Or indeed, we might choose to help them wind up because we might find that the the opportunity actually doesn't have the promise they initially thought, or indeed the technology might be carbon positive rather than negative, and no path to the latter. So what we want to make sure is those that fail for the right rather than the wrong reasons. So in that first stage, 360 investments. And when we say every investment cycle, the cycles will get tighter over time. So initially, because of course we need to build up our investment capacity and offices and our systems, we will do less, and then over time more. So the cycle will initially be a 3-year cycle. So it'll be 120 investments a year. And then it will then get to 180 investments a year following in years 4 and 5. And then from year 6 and onwards, it would be investing at capacity of about 360 investments every single year. And that $500,000 that is spent on organized help and support, we'll talk about that in a moment. But then from those 360, what we intend is 90 follow-on. So roughly a quarter will get a follow-on investment. As you can see here, it's $3 million of cash and it's $1 million of organized help and support. Now, just imagine yourself in the seat of a fund, as a infrastructure investment or a tech impact investment. Doesn't matter. There's so many areas that we can cover. The themes and sub-themes are designed to be diverse because you just don't know initially which will deliver the impacts, which will deliver the financial returns, which will, regardless of financial returns, are really important to do anyway. And bearing in mind, we can do some of them through the big crowd model. We can raise other capital. So we're not restricted with this one structure. We've got many ways of actually supporting truly deserving entities. But where we're providing that $3 million of equity and $1 million of help and support, that means that over that cycle, every three years, and then 2 years, and then every year thereafter, although it might be staggered a little, as you'll see in a moment, we're putting $450 million of investment, but $270 million of organized help and support. And if you've watched the other videos, particularly the one that explains big crowd, you recognize that these forms of support, accounting and legal and talent and recruitment and social media and storytelling and events and strategy and technology and everything that you can see there, fundraising, of course, all of that is where we'll be spending that organized help and support in our own incubation facilities, but also in partnership with others as well. So that means we can get really close, but we can also fully incentivize that ecosystem to participate. So what then happens is from those 90 or so that have essentially $3.5 million of cash and $1.5 million of organized help and support, what we're able to do is better select which ones are really worthy of scaling. So, and bearing in mind, they compete. So the teams that you can recruit can be much more efficient, much greater, because they recognize that the follow-on capital is there if they perform, if they show that this is not just about the financial returns, but it's the combination of returns and impacts around truly important issues. So the follow-on round is around about 30. Every cycle will get a follow-on 12 million. And then 12 would get 30 million or so. Now, bearing in mind, these are averages and the numbers can differ, but the idea is the principles hold true. This is about a diverse, dynamic portfolio. From those 12 that get 30 million, 6 of them would have a follow-on 60 million. From those 6, 3 would get 120 million. And every cycle we'd be looking for one that would have a round at the end of those 1, 2, 3, 4, 5, 6 rounds. The 7th round would be £360 million. So what you can see here is when the numbers are added up, one would have 587 million, 2 would have 227 million, 3 would have 107. That's it from us. Although There's something we're going to add in a moment. 6 would have had close on 50 million. I think 18 would have had 17 million. You get the point. But what's exciting about this is we can add co-investors at any time. At the earliest stages, this could be co-investment from crowdfunding type models or investment syndicates. Could be from venture investors, and it could be from many other strategic players, corporate venture investors especially, and many others that could really add value in the best way. So this structure provides kind of like an institutional backbone. So you can see here the investment schedule means those cycles, they get tighter over the first few years. The first cycle would last around about 6 years, and then you can see 1, 2, 3, 4, 5, and then 4 years. And then it would be a cycle, a staggered cycle. But of course, it's designed to be flexible and adaptive. Okay, so that is what we call the butterfly basket portfolio structure. And obviously, we talked about the fact that it's a butterfly and a basket, and you can see the arrow there. That's really designed to be the institutional backbone that enables other investors to participate. And you can see to the right-hand side, those few real large ones can enter the public markets. But what's really great about this and this particular structure is even if they do, we're able to hold on to the equity for the long term. We can be very flexible. So it's really about giving management teams what they need. It's giving the impact the greatest chance of succeeding. And some of the businesses might not build to mega organizations, and that's okay. Some of the smaller ones might just want to grow through replication and distributed methods of manufacturing and funding, or off-balance sheet financing. It's fine. What we want to do is make sure the portfolio is using its capital as efficiently as possible to support those truly game-changing initiatives, but recognizing, many will fail earlier on. So it's all parts. They funnel and filter and connect to create this progressive and intelligent deal flow pipeline. So every cycle, 360 investments, they will receive that $1 million of risk equity and support, and they're competing for the dual criteria of high impact and financial potential. And therefore less deals, as you can see, get more capital through those different stages. So it's not really, as you can see, it's not just about tolerating, but it's about embracing healthy levels of risk at those early stages. It's truly important. But then you can see, because of the deal flow, that discovery and dynamic structure, it means you can generate healthy impacts and you can generate very strong returns harnessed at the later or the mid and later stages. So it's designed to really work a little bit like doing the capacity building that many ignore or do or expect others to do. We think this is a mistake, but it enables us to do the capacity building and scaling in one fund. Everyone wants to do the latter, and everyone ignores, not everyone, but many ignore that early stage activity, which is the lifeblood of any economy. So think about it. It's a bit like putting seed and angel investment with venture capital and then with private equity, but in one connected but very dynamic system enabled by that augmented intelligence decision support engine, collecting data, remediating with that data and making sure that the entities are optimized for impact. That's really the goal. And by doing so, we know we can generate really great returns. So the model is supported by Transform Global, the bank, as we've talked about, and by the media and technology platforms of Transform Global Media. So let's talk about the risk profile. It starts high, of course, but it reduces as those stages increase. Of course, the more data, the more understanding, the more you help them, the risks are lower. Now, the returns, although we embrace a healthy level of failure early on, many of those that don't need a lot of money might also be able to generate significant returns. But for this model, we kind of ignore those returns, or we don't need them to be generating them for the model to work. So of course we want them to, and we want the discipline to be in place, but equally we want to make sure that we're not putting too many conditions about fast returns, because if we do that, we know we won't be taking the risks that the world really needs. So it's about understanding, managing, and taking risk appropriately. But the returns can be pretty significant as things progress, because we're figuring out the ones that can enter the markets. And although we might put with those each deal, each cycle, we might put one investment that would have around about $500 million, 587 million. That investment might go on and raise several billion externally from the markets, and we might do several of them. So this is really an interesting structure where collectively your impacts start medium, but they can be stratospheric when you look at the ones that are really, really impactful and scalable. So for this to work, it's a conservative portfolio return of 2 to 2.5 times multiple. Again, this is on an unleveraged structure. If we're able to have strategically underwritten debt of any size on the entire portfolio, or indeed on the individual deals, we can certainly overperform. But the target portfolio return would be 2.5 to 3.5 times. And we believe that massively gives the investors something that they will find more than attractive. Okay, so I'm going to talk about a disclaimer. So all the values that we're talking about here, they're based on a multifaceted set of assumptions. And while myself, the founder, I believe that they are achievable, it's important to note that any investment carries an element of risk. And that said, the business plan includes flexibility. It's got a number of ways of risk mitigation, and it aims to deliver acceptable investment returns for investors should a cutback and smaller version of the vision be achievable. I have to mention that this could include fewer and smaller rounds of equity being raised for the bank itself, or indeed for the fund, and potentially not raising the SDG 360 Gamechanger fund. Now, impact investors should take advice and consider if the potential impacts on truly important issues warrant the risks that they perceive that could be included, or could include a longer time frame, smaller financial returns than illustrated in the target plan, or which, in exceptional circumstances, could include the total loss of funds. It's important that I say that, because we know that many things can change. We're in a world that is incredibly complex. Financial markets can collapse. Investor ability can be limited. But we really do believe that this is an idea whose time has come. So now I'm going to talk about the investment structure. And what I'm going to do is I'm just going to change where I am on the screen. I'm just putting myself up there now. So you can see this model has 3 assumptions for total returns: conservative, medium, and target returns. And you can see here each of the stages: the 1 million, the 4 million, all the way up to the 360 million. And you can see here the first million investment, we're discounting all of those investments. We're assuming they will create a complete loss. And then the returns range from 1 to 3.2 times for the early, mid, and late, and 1.4 to 4 times return, which overall can generate a pretty healthy return for the portfolio. Now, of course, there's a lot of underlying assumptions, but now what we're going to talk about is the full model for when we're bringing this capital together. Now, we talked earlier about there's 4 ways that the fund would invest. So one is the investment into Transform Global itself. One is the investment into the special opportunities. The third is the butterfly basket portfolio structure. And then the fourth is the active on-market investment, impact investment. So this is where it brings together everything that we seek to do, and I'll explain how. So what we're showing here is the net capital raised at launch and at IPO. And to be conservative, we're showing the 9 billion raised at launch, and we're then showing a further 2.5 billion raised at IPO, not the 5 billion that we're targeting. And rather than within 2 to 4 years, we're showing it to be raised within 6. So what that bottom line with the yellow block in the middle represents is the direct impact investments that we'll be making, both with the bank itself, with the investment into the bank, the investment into the special opportunities, and the investment into the butterfly basket portfolio structure. Now, as you can see here, this is what the running total would be. So if we were investing, this only shows 10 years of investments. I'm just going to take a sip of water. So this shows 10 years of investments, and roughly 15 billion would be invested, which might give you a question to answer. How do we invest 10 billion when we're showing 11.5 billion raised, the 9 plus the 2.5? Well, I'll answer that question in a moment. The blue represents the cash flow. And as you can see here, what would happen is if that was all we were doing, making those direct investments, at around 8 years, just over 8 years, we're out of money. We've got some incredible investments, but we're out of cash. However, we've got to take into account exits from the portfolio. So what we allocate and what we show is some exits in the 5th year, some in the 8th, and some in the 10th. But what that does is it changes the cash position. Now, this particular assumption set is based on only raising or only achieving a 2 times return on the impact investment portfolio. So I do believe I'm being conservative. Now, if you include those exits, you can see at the end of that 10-year period, there is still capital. Now, it's depleted a little bit. You can see it's probably about 2 or 3 billion of capital, but it means you still have the ability to keep on investing. Now, what we didn't talk about is the gross asset value. So the gross asset value, which is net actually of the exits, so those exits are removed. And so assuming that 2 times return on the portfolio embedded into the entire portfolio, it means the value of the portfolio at the end of a 10-year period is somewhere in the region of 24 billion pounds. But we've got something that we've missed. And you can see here, we've still got that cash balance that we've just, on this assumption, left on deposit. Now, of course, we don't want to be doing that. And as we've spoken about, we're going to be doing impact investment with some respected and a diverse group of investment managers, those who are doing impact and those who are also giving the ability to have liquidity. So it won't be locked into private equity style 10-year funds, but it will have what we call selective liquidity, meaning there will be a lock-in, perhaps a matter of months, but we will be able to take and to draw from our liquid investments to be able to keep making fund investments directly. So based upon the quite conservative assumption of just a 6% internal rate of return, it shows that we've still got somewhere in the region of 6 billion at the end of that 10-year period for us to keep investing on an ongoing basis. Now, of course, assuming we're doing that, the gross asset value increases as well. So we've got a gross asset value because of the additional returns of somewhere in the region of 30 billion, just under 30 billion at that point. So this all contributes to the underlying value and the expectation of the fund. Now we'll show 2 other assumptions. This second assumption, the more moderate assumption, assumes a 9% internal rate of return and a 2.5 times return on the impact investment portfolio. And of course, the exits are changed a little bit. So at the end of that period, we still have over 11 billion in the cash portion for us to keep making the ongoing investments. The ongoing investments can increase at that point. But we've now got a net asset value of around about, or gross asset value of around about 40 billion. But then on our target return, it's a 12% internal rate of return, but also 3 times on the impact investment portfolio. And assuming we can do that, then of course, the value, the cash value is increased a little bit. You can see there increasing, and the gross asset value is somewhere in the region of 50 billion pounds. This is using sterling as the mechanism. So as you can see, that's my vision for a new World Bank, but better. Now, a new World Bank, but better is a provocative term. The reality is we'll probably be a solution provider for many of the existing multilateral development banks or development finance institutions, and we'll provide them with deal flow. Potentially they will be investors, will be partners, and able, with this structure that isn't constrained geographically. Of course, we will be constrained legally. There's certain areas that we will not be able to operate. But aside from that, thinking of certain geographic regions, which I won't mention, but the goal basically is to operate as far and as wide as we can in the world without the restrictions that traditional development finance institutions and others have. At the same time, we're not only focused on the financial return that conventional investment banks often limit their investment and their asset allocation and talent allocation decisions. So we'll be partners for them too. So it's a provocative term. At some point we may drop it, but the whole point is that Sustainable Innovation and Development Bank is a vehicle where people, wherever they are, with incredible talent and the ability and the desire to really put capital to work and their skills and technology capability and understanding, where they can put it together with high talent density, where that collective impacts, I mean, they can do well financially for sure, but it's really about getting a culture that is focused on impact at real scale. Now, it doesn't mean ignoring small projects and ventures and things that have the seed of something great. It means supporting them too. But with our model, we can do it through the foundation. We can do it through the big crowd or the Funding the Global Goals.tv media platform, because we recognize that from those little acorns, amazing oak trees can grow. But most importantly, by doing so, that the complete vegetation of the forest can be nurtured and better managed for the good of us all. And I think you know that I'm talking about the investment world that is and should be highly aligned with nature. Case in point, I developed an economic theory, which I call the economic food chain theory, which I will be updating a presentation on in the coming weeks. But for now, and that theory explains why capital concentrates to major corporations and financial institutions, and it doesn't get to the plankton of our economic food chain, and what we need to do to fix it, to get that capital back to those parts of our investment worlds that are literally the lifeblood. Well, the model I've just shown you is really about doing that in a systemic and organized way, and a flexible way, but one that is designed really to maximize the chances of success and to speed up those successes, as well as managing the failures. And there will be failures, but what those failures, if you're educating people, they're also successes. So it's important just to do that in that portfolio approach that we referred to that can tackle this intelligently. So thanks very much for watching. I really do encourage you to engage on any of the social media platforms. Do come into my Clubhouse rooms, like, share, comment, and subscribe if you can. Watch the additional content, and the additional content you'll be able to learn about in the About section of this YouTube video, if you're watching it on YouTube. If not, you can also see it all on transformglobal.co. We're going to be updating the homepage. There's also the the websites for bigcrowd.net and fundingtheglobalgoals.tv. So thanks for watching. If this is relevant to you, if you'd like to get in touch, if you want to learn more, if you want to be involved, just reach out. There's a way of finding me, and I'd be glad to respond. Many thanks.